Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. This allows individual investors to benefit from professional management and diversification, even with relatively small amounts of money. Mutual funds provide an opportunity for investors to participate in the financial markets without the need for in-depth knowledge or time commitment. Advantages of mutual funds for investors. Diversification. Mutual funds hold a variety of securities, which helps spread risk across different assets. This diversification reduces the impact of poor performance by any single investment. Professional management. Fund managers have the expertise and resources to conduct thorough research and make informed investment decisions, potentially leading to better returns. Accessibility. Mutual funds are accessible to a wide range of investors, including those with limited capital, as they can invest with relatively small amounts of money. Convenience. Investors can buy and sell mutual fund shares easily, and some funds offer automatic investment plans, making it convenient for investors to contribute regularly. Types of mutual funds. Equity mutual funds. These funds invest primarily in stocks, offering the potential for high returns but also carrying higher risk. Bond mutual funds. These funds invest in bonds, offering regular interest income and lower volatility compared to equity funds. Money market funds. These funds invest in short-term, low-risk securities and are often used for preserving capital and providing liquidity. Balanced funds. These funds invest in a mix of stocks and bonds, providing a balanced approach to managing risk and return. How mutual funds work. When an investor buys shares of a mutual fund, their money is combined with that of other investors to create a pool of funds. The fund manager uses this pool of funds to purchase a diversified portfolio of securities in line with the fund's investment objectives. The value of the mutual fund shares fluctuates based on the performance of the underlying securities. Investors can earn returns through capital appreciation and income distributions, such as dividends and interest payments. Factors to consider when selecting mutual funds. Investment goals. Investors should consider their financial goals, risk tolerance, and time horizon when selecting mutual funds. Fund costs. Investors should be aware of the fees associated with mutual funds, including expense ratios, sales charges, and redemption fees. Historical performance. While past performance is not indicative of future results, it can provide insights into how the fund has performed under various market conditions. Fund manager's track record. Assessing the experience and track record of the fund manager can provide valuable insight into their investment approach and decision-making. Risks associated with mutual funds. Market risk. Mutual funds are subject to market volatility, and the value of the underlying securities can fluctuate in response to economic and market conditions. Interest rate risk. Bond funds are exposed to interest rate risk, as changes in interest rates can impact the value of bond holdings. Management risk. The fund's performance is influenced by the decisions made by the fund manager, and ineffective management can adversely impact returns. Mutual funds offer an efficient way for investors to gain exposure to a diversified portfolio of assets, access professional management, and achieve investment objectives. However, investors need to carefully consider their investment goals, fund costs, and risk factors before selecting mutual funds. By understanding the types of mutual funds, how they work, and the associated risks, beginners can make informed investment decisions and build a well-rounded investment portfolio.